Welcome everyone. Podcast number 2. In our first one, we talked about needs and efficiencies and how insurance is used by high net worth and business owners. And we sort of talked around, establishing the need and then using insurance as one of the tools in your tool bag to deal with some of those tax liabilities and to identify and sort of work through some of the priorities of the family on all the wealth they built up. For today, what we're going to talk about a little bit, we're going to get a little bit more, we'll try and stay high level, but we'll talk a little bit more technically about some of the concerns, I suppose, we have in terms of things to look out for, not necessarily pitfalls, but structural issues, presentation, illustration issues, and some of the things that we should be all looking out for to make sure that something is, in fact, structured properly. So we'll talk a lot about things, sensitivities to how these things are going to work, whether it's dividend scales. We're in a growing interest rate environment right now. There's a lot of people that are doing these funky, just paying the interest only. So we'll sort of dive into that. I thought, Mark, we'd start with you because, as the professional, the accountant who's dealing with the front line of these people, you must have experienced, many cases where their agent brings something to them and, something just doesn't quite hash out properly as time goes on. Do you want to comment on any of that?
Yeah, so I think when you sit back, insurance is a complicated product. You two guys may be able to simplify it to some extent, but it is complicated. So for most clients that have had limited experience with insurance, it really is a hard concept to grasp. There's so many technical illustrations that, in my experience, sometimes they've not been exactly clear. The accountants who are sitting with the clients, have working knowledge, some to a high degree, some to a limited degree. They're somewhat intimidated sometimes by the insurance discussion. And so it's a really hard discussion because the client is having trouble grasping the concepts. The accountant has it to some extent, or maybe a large extent, and no one's ever sure 100% what's going on. So, so for you guys, one of the pet peeves I've had is I'm sitting in a meeting with a client, and the insurance advisor comes in, and right away they're talking about, the greatest thing about insurance is you're going to get in a corporate environment, you're going to get the life insurance proceeds paid to you, and it's going to go into this capital dividend account, which we talked about this briefly in the first podcast, but the capital dividend account is a tax-free account in a corporation. And so this is all great to Mr. Client or Mrs. Client. You're getting upon your passing, all the funds are going to go, the insurance funds are going to go into corporation, and they're going to be paid out tax-free to your beneficiaries. And, the return on investment is great and everything looks great. But, sometimes when I sit back and I consider other aspects of it, there are tax rules, are a bit technical, called stop loss rules that maybe Jay can briefly describe. They're super complicated, but maybe you can simplify them, that never seem to be accounted for. And a lot of times the advisor doesn't take into account, well, hey, there's a whole bunch of other assets in this corporation that have to be dealt with. And the client walks away thinking, wow, everything's tax-free and it's hunky-dory. And, so I find sometimes it's these conversations, are lacking a little bit in depth and clarity.
Mark, you're so right, and I think in the last podcast I separated personal insurance versus corporate insurance. And personal insurance, the tax laws are pretty straightforward. When you go on the corporate side of insurance, you just mentioned one of the things we got to worry about is stop loss rules. I'll get into that in a second, but I'd say there's three things that I don't think generally are explained very well by the advisor or by the other professionals, accountants and lawyers, partially because everyone only understands a piece of it, and partially because they're talking about it in the present as opposed to the actual administration of the estate, which are two very different things. So let's start off with you mentioned the capital dividend account. So capital dividend account is, it's not a real account. And what I mean by a real account is, people often think of it as like a bank account has real cash in it. There's not, I wouldn't describe it that way. I would call it a notional account. It's a tracking mechanism. It allows what amounts that have arrived at the corporation tax-free, it allows them to exit the corporation tax-free. So with life insurance, what credits the company's capital dividend account is, it's the death benefit, credits the capital dividend account, minus the adjusted cost base. So the adjusted cost base is what you've paid for the policy, minus mortality charges. And the mortality charges are a table that the insurance company uses that's provided by the government, and it grinds down your cost. And so mortality, meaning how long I'm going to live, it's related to my life expectancy. So my entire cost, meaning what I put into the policy, it takes at least until my life expectancy to be ground down to zero. So when someone says insurance can be stripped out of a corporation 100% tax-free, that's true, but it depends on when. If I paid $100,000 for my $1 million policy and I died the next day after putting that $100,000 in, only $900,000 of that $1 million is going to come out tax-free, because it's a death benefit minus the adjusted cost base. And in year one, my premium that I paid has not had time to get ground down. So I won't get the full amount out. Now, from an IRR perspective, going back to my comment from the previous podcast, because insurance is a negative rate of return, I'm still financially better off to die in year one and not get the whole thing out through my capital dividend account than I am to die in year 40 and get the whole thing out through my capital dividend account. But it is important to recognize that the whole thing doesn't come out tax-free until I live to life expectancy. So that's probably one major thing that's not often explained, exactly how the capital dividend account works. A second kind of thing that we can deal with is, with permanent product, we mentioned in the last podcast, cash value. Cash value, again, is what an insurance company will give you to go away if you wanted to cancel the policy, but it's real, it's there. The CRA has said that, or not CRA, but in a 1984 case in the federal court, there was a case called Masternardi, and the debate in that case was whether life insurance counted towards the value of your shares on death. And the court said, and it's been followed ever since, that when you're deemed to dispose of your shares on death, you're deemed to dispose of them for fair market value, that the death benefit from insurance does not count towards that fair market value on that deemed disposition. And the reason is because you're deemed to dispose of your shares 1 second before you die, and that proceeds of the life insurance doesn't come in till after you die. So that's a great thing, in that the estate is not taxed on the value of the life insurance. Having said that, they did make it very clear that the cash value of the life insurance did count towards the value of the shares. And the reason is because that is realizable during your lifetime. You can get that cash value. So if a policy has been held long enough, and cash value being nothing other than a percentage of the death benefit, what the insurance company will give you to go away, as you get older, that cash value goes up, and it goes up because the older you get, the more the insurance company wants you to go away, because it's more realistic that they're going to have to pay the death benefit soon. So if the cash value is 80% of the death benefit at some point, and that cash value counts towards the value of the shares, the estate is still going to have a capital gain based on the value of that cash value. Now, there's ways to deal with it, as far as, we can do insurance shares, we can do estate freezes. There's ways to deal with it. I'm not going to get into detail today, but the point is that these are issues that have to be recognized. In fact, you could buy a policy that had no cash value, that would avoid that issue entirely. But these are discussions that should be had when you're buying, corporate-owned insurance. Lastly, and I'm sure there's a few more that I'm not
Jay, if I can just throw in there, so just as something for people to look at, if you have, and again, maybe in future podcasts we can talk about this, but if you are someone who owns a policy with cash value in your company, and that company is being wound up when you die, in other words, it's not succeeding through your kids, it's not succeeding through your spouse, then this is a, what warning is not the word, but maybe a heads up that that's a situation that you should be looking at is, do you have a cash value product that is actually going to be viewed as being deemed to be disposed when you die in your corporation? Because that's a problem that you want to remedy.
Yeah, and so you're just kind of reminding me of, and Mark, this may be a good place for you to pipe in here, is there's the role of the advisor and there's the role of the accountant. Some accountants understand product very well. Some advisors understand tax very well, but I do think there is a little bit of separation in roles here. So no different than any other asset, and I do believe insurance is an asset in and of itself. No different than any other asset. For sophisticated individuals with complex ownership structures, they shouldn't be getting advice from their accountants and their lawyers as to product and whether or not an investment is good for them or not, but they should be getting advice as to structure, where it should be held, how it should be held, what are the tax consequences of holding it there. And you just mentioned a case where the company would be wound up on death. So not only with the cash value did you have that deemed disposition issue to make sure that it was structured properly to avoid that. Mark mentioned something earlier called the stop loss rules, and I'm sure you guys have both seen financial plans, and I have so many clients, either I've done a financial plan or somebody else has done a financial plan for them. The problem with financial plans is they end the day the client dies. they don't continue, so you don't get to see what happens in the estate. You don't get to see what happens with the kids. So when the financial plan ends, it's going to show a capital gain. Here's the deemed disposition on death. These are your taxes. Now, practically, for example, Simon, you talk about a holding company. Clients have a holding company. They pass it on to their kids. They've got 3 kids. In most cases, it's unlikely that the 3 kids are going to continue holding this holding company together. They're in 3 different financial situations. They have 3 different values on money. They have different spouses. They're going to want to go their separate ways. If they go their separate ways, they're going to wind up that company. So when mom and dad died, there was a deemed disposition and there were capital gains paid. When they wind up that company, that wind up is taxed as a deemed dividend. The kids now wind up the company, it's taxed as a deemed dividend. When it's taxed as a deemed dividend, let's just use a rate and say it's 45% tax. And mom and dad paid 25% tax yesterday. Now the kids wind up the company a couple of days later, it's 45% tax. That's 70% tax. That sounds very unfair. The government gives us one break on that, and the one break is if you wind up the company within 1 year of passing, the deemed dividend creates a capital loss that can be carried back 1 year and offset the estate's capital gain, i.e. you pay the higher of the 2 taxes. You pay the dividend tax, not the capital gains tax. There is a rule in the Income Tax Act that says, to the extent that the capital dividend account has been elected on the deemed dividend, that will grind down the loss that's available to be carried back to the estate, meaning you can't completely wipe out your tax bill by using insurance for that entire deemed dividend to credit the capital dividend account, have no tax on the dividend, and also get the loss carried back and have no tax on the gain. So there's a mechanism, Mark referred to it, called stop loss, that reduces that loss carryback. There are strategies, viable strategies, nothing gray here, viable strategies to reduce the impact of that. But again, it's not something that's often talked about. And not only not talked about from a tax perspective, I think this is the important part. It's not talked about from a practical perspective. People don't talk about what the kids are going to do with that company once they get it. They do have that conversation a lot when it's an operating company, because we have to decide who's going to be the successor, how they're going to lead it. But when it's a holding company, it's very rarely talked about. And this is an issue not only for insurance, it's an issue for general estate planning, but it can be an issue for simple things like Mark mentioned before, equalization. It could be an issue for an estate freeze, because again, what's the point of an estate freeze if I'm going to wind it up the next day? So again, this all comes back to something we were talking about in our last podcast, is you start these things off with practical conversation. What's going to happen, right? And if the kids are going to wind up that company, then things like stop loss rules become very relevant, and it's important to have that conversation.
Yeah, so I think that comes back to, Jay, as you mentioned, that you have two separate advisors here, potentially, or three, and the insurance advisor, sometimes the lawyer is involved, or planner, and the accountant. And, I think it's important that they all work together, but the reality, and part of my problem as, when I was an accountant, was that they work a bit in silos. The insurance advisor is often just, purely giving the insurance answer with a definite, bent towards the all the positives, and not dealing with any of the other things. And the accountant is, maybe picking up some of the stop loss rules and other aspects of it. But, they're very complicated and intricate, and they have to work together. And I guess that was sort of one of my issues, is that, it's very hard to get the coordination of the two, because one is trying to, one advisor is bringing a product that, at the end of the day, they want to sell if they think it works for the client, and the accountant is trying to make sure the client really needs that product. And it's just that I just found that it was a lot of lack of integration between the two.
Yeah, and it's funny, Mark, neither of them are wrong. That's the beauty of it. I mean, insurance is a standalone product, with the right pricing and the right underwriting. As I mentioned before, it has an inherent IRR, has an inherent internal rate of return. It's not up to me to tell anybody else what a good return is, right? Like, I could say, 6% guaranteed is an unbelievable return, and you would turn around and say, if I got anything less than 20%, I'm not taking it. Like, there's no right or wrong answer as to what return is. That's personal. But so client could buy this policy independently because it's a good return. But if they're doing that as advisors, why wouldn't we want to optimally make sure that we've done everything we can to make this more tax efficient, which will naturally increase that return, or if we've not done it at all, could decrease that right. Return.
So we don't want to encroach on these gifts, these efficiencies, by mishandling, the example we just used, where there's a ton of cash value and the company's going to get wound up, and that gets added to the share value. We don't want to mess up because dividend scales were misquoted, or there wasn't enough of a sensitivity analysis. We don't want to, overstate that not all of that death benefit flows out through the CDA. Some of it may have to be dividended out. So it's just a function of, if we're going to have that IRR conversation, which from you guys may have different opinions, but my approach has always been that this all comes down to a comparison of IRR and risk relative to the options you have to deal with the problem. So establish the problem first. We owe this. We need to give this to Johnny and this to Mary, and so on and so on. How do I keep the most? We need to be accurate and almost, ruthless in our conservatism to make sure that our clients understands the worst case scenario, so that we structure it properly. And nothing.
So, Simon, you mentioned dividend scale, and I just want to step back for a second. Another huge issue with my clients is what's confusion between universal life and permanent insurance, and dividend scale relates to the permanent side. So I think maybe if you one of my other pet peeves is going to be the dividend scale, and we'll get back to that in a second. But I think maybe if you could just explain a little bit about the difference between UL and permanent, because that was always an issue that clients sort of were not clear about.
Sure. So let's actually back. So you've got two people overcompensate. Insurance is so complicated, and it really isn't as complicated as it's made out to be. I think maybe the way that people pay for it is what creates this confusion, because agents have tried to differentiate themselves by creating these intricate concepts and all the rest of it. And I know I speak for Jay when I say that, we like it, as we've said before, sort of the simplicity and the elegance of doing it the way it was intended, and not sort of bastardize its intention to put yourself into a position where it might get challenged. There's term insurance, which covers short-term needs, and there's permanent insurance, which isn't by its name, is a permanent coverage. Within that permanent, there's two product categories. There's universal life, as you mentioned, and there's whole life. Universal life is it was very big in the higher interest rate days, and it may come back. Jay and I actually happen to also still like it today, because what you see is what you get. It has an insurance component. The insurance side, on that side of the ledger, is typically guaranteed. Here's your rate. It's not going to change. And then you have this ability to put in more money and put it into several different choices of to put your surplus cash into several different vehicles to grow that money, whether it's, and they're usually either guaranteed investment vehicles or they are sort of
indexes or funds.
Yeah,
indexes
funds,
or funds.
Insurance versions of mutual funds. So let's call them segregated funds, which have their own MERs and so on and so on. Again, I'm not speaking for everyone. I don't do the segregated funds. Jay doesn't do the segregated funds, I don't believe, because that is more of my specialty is not investments, so I don't make recommendations on.
Well, and actually, it goes back to the comment that you gave me credit for earlier, Simon. I think on the last podcast, where it said you don't add risk to a risk-free product. Right. So, Mark, if you're looking at universal life versus participating whole life, participating whole life is kind of considered a black box. I mean, you are investing, you are participating with the insurer. We're putting money into a policy. The insurer, makes their estimates, and they say, this is what we need. This is how long we think our clients are going to live. This is what we think our expenses are going to be. This is how many people we think are going to walk away early. This is what we think our investment performance is going to be before we have to pay out the death benefit. And to the extent that they exceed those expectations, they share their profit with the clients in the form of what's called a dividend that buys usually what's called paid up additions and grows the value of that policy. What some people don't like about those policies is that it's a little bit of a black box. They can't really see how the insurance company is making money. So in 1982, they created an alternative product. I think it was 82, around maybe 80. They came with an alternative product called Universal Life, which is what they call the unbundled product, which separates the insurance component from the investment component, as Simon suggested. And although you can invest in guaranteed investments, like they're called GIAs, it's very similar to a GIC, indexes or funds. If you're investing in indexes or funds, as Simon suggested, the money can go up and down and can be negative, which means you can lose money inside there. In a participating whole life, you can't lose money. The worst that could happen theoretically is that the insurance company could pay you a dividend of zero. We've never seen it, it's never happened, but in theory, that could happen. Where I think the issue that you're talking about, Mark, and very, very, very common, both in universal life, but I would call it more back in the day, but maybe occasionally now, where people give the clients a quote and they assume a return. They say the universal life is going to perform at 7%. Under the assumption that the client is going to invest in indexes and funds and it's going to perform at 7, which is not only difficult because of the fees involved, but is hard because the money is going up and down in an index or a fund. Even if it's averaging 7, it's going up and down. And in the negative years, if you have your cost of insurance being withdrawn out, it can't recover to give a 7%. So I think that's probably the number one reason Simon and I don't like equity type things in those policies. On the whole life, when you're quoting a return, if let's say Manulife, Sun Life are paying a 6% dividend today, you can quote at their current dividend at 6%, or you can start taking off points, -0.5, -1, -2. And I think one of the problems that you're identifying is, what happens if somebody quoted at -1 and the policy ended up performing at 2 points lower than that? Are they going to have to put in more money? Can you stop and just take a lower amount? And again, I'm not going to give all the answers today. I think that the bigger question is, are these things addressed? upfront, and what are the downsides. So I think, I know Simon and I have known each other a long time. We're philosophically aligned in a lot of ways. We tend to only do products that have guarantees that stop the payment after a certain point. So it usually is not ever about client having to put in more money than we initially anticipated. But if the insurance company performs below expectations, the end death benefit might be different than initially quoted. And again, those things have to be disclosed from the beginning, that there is variability to this. And if it's not something the client can handle, then we're looking at the wrong product.
I think it's very important to just to piggyback on that. I think it's just really important to, philosophically, we'll go to a client and say, we've shown this with the following variables, the following assumptions, including dividend scale or interest rate scale, if they're doing leveraging, for example. And to quote it for the purpose of the sale, we want there to be sizzle, but at the same time, our approach, I know certainly Jay, again, same boat as me, the approach is we're going to go ultra conservative. Let me explain why I went conservative. Let me show you what variables I used to go conservative in terms of tax rates and interest rates and dividend scales. And our philosophy is that if you, Mr. and Mrs. Client, can be happy with these numbers and the rate of return that it brings, then our belief is that you're going to be happy long term, because it's not going to do, we hope, not going to do worse than what we've shown, because we've gone ultra conservative. If you could live with the conservative numbers, then you're only happy in the future. And I think that that's a better way to do it, is to sort of under promise and over deliver. The other area, of course, which we'll talk in another podcast, is sort of our specialty around underwriting, is that first quote, when you first sit down with that business owner, most commonly it assumes a standard rating, meaning that you are in the perfect rate, the perfect health condition to be accepted by the insurance company. The first level of rating commonly can bump that premium. It doesn't change the death benefit, doesn't change the cash value necessarily, but it ups your cost base, it ups your premium, sometimes as much as 25, 50% as a starting point, let alone 100, 200, 300% more. So again, that you could be making a decision based on dividend scales, interest rate scales, the assumption of how the insurance company is going to view you. As an aside, what we do is we manage the health so that we can drive the price down through underwriting. And therefore, by driving price down, we drive down the cost base and therefore increase the long-term rate of return. I'm more on that another time, but I think underwriting risk has to be another one to consider.
Yeah, and I think you guys addressed that, alternative scenarios is really important. And sometimes, as an accountant sitting there, I haven't always seen, alternative scenarios be addressed, and we have to provide it. And that, I guess that's just something for, anybody looking at a policy, just to make sure that when they're looking at it, make sure there are these alternative scenarios. And I guess the question is,
Mark, I just want to highlight something there. So this is the difference between the agent and the insurance company on that. Like, the insurance companies do a very good job. Obviously they're trying to protect themselves from lawsuits. But in the paperwork the client's signing, it actually does go through the scenarios to say what would happen if the dividend dropped, and the client acknowledges that. Very rarely do I see the agent actually properly go through the paperwork with the client, and that's understood. So, and the reason I mention that is because, if you're sitting there 2, 5, 10, 20 years later and you're saying this thing's not performing as I was told, and we all know memory is a shady thing anyways, so everyone's going to go back to the paperwork. The client's going to be in a position where they probably signed paperwork that warned them of all of those possibilities. But I think we all know that, unfortunately, the advisors don't always do a fabulous job explaining every detail of what a client is signing.
Just back to that point about, they don't always perform as expected. I don't recall how many years ago it was, but there was, whatever, 10, 15 years ago, where a lot of the policies didn't perform as expected. And and clients suddenly had to, put in a lot more money for certain policies. What's the risk of that type of thing happening these days?
I mean, the risk is still there. I think it's less only because interest rates are lower. But, if you're talking about, in the 80s when dividend scales from insurance companies were 12 and 13%, and people made assumptions that, I'm going to put in a very limited amount of money into these policies, and I'm going to let those fabulous 12, 13% returns pay for my policy for the rest of my life. And those returns, functionally dropped more than half over the following 20 years, and the policy couldn't support itself. Big problem. Today, two differences. Number one, there's more guaranteed product out there. Like you can buy, for example, a guaranteed 10 pay, where the insurance company guarantees that you're not going to have to put in more than 10 years. That wasn't available 25, 30 years ago. All limited pay products were dependent on performance. They're not all dependent on performance today. So that is a good thing. The other thing is, and this is just practically, with dividend scales are now down to that 5-6% range. So their level to drop is significantly less than they were before, and they can't go below zero. So I think the risk is less. It doesn't mean it's not there, but it's definitely less. And a responsible agent will show you all the scenarios.
Yeah. So if you look at it, Mark, even over the course of the last, call it 10 years, where we said, geez, interest rates, I mean, they're record low. How could the dividend scale go down anymore? And again, we're not going to get into the technical piece, but we still did illustrate them at a full 2% below the current performance, because there is something called a lag. So even though it's a low interest rate, it may take time over 5 years. They spread that risk out over time. Now we're in a world where the interest rates are going up, and that doesn't necessarily, again, mean that if I was given an opportunity to go with a +1, for example, or a current, there still is a lag. It still takes time. And we're not looking at the next 10 years. We're looking at the lifetime of a client. So, the person who in the 80s got an illustration at 16%, I'm pretty sure that they're not going to recover. I think a person, on the other hand, that was in the last few years, not that I'm in the prediction business, but over time, if you illustrate it properly at -1, -2, then I think we are in a position where a client can feel safe that over time that you're going to get lots of recovery over time.
Yeah, and to be clear, just because the dividend dropped dramatically doesn't mean it's a bad investment or a bad product to have bought. It's all about whether or not you understood that was a risk. If I invested something in the 80s that was 12-13% return, I was obviously comparing that investment at that time, if I was going to buy this or buy that, to other high yielding products, because that's what the things were doing at that time. And if I bought anything, if I bought a bond instead, obviously 25, 30 years later, I'd be getting a lot less on my bonds at the same time. The difference with insurance is, I'd happily take 12-13% returns, even if it meant I was getting 6% returns in the future when an average interest rate was 2%. I'm fine with that. I'm above where I otherwise would have been. My problem is not the returns and the fact that the returns are going down. They're going down slowly. They're stable. They're in line with what other things that are happening in the world. It's a diversified, stable asset class. The problem is only if I was never explained that it could go down, and that if the amount of money that I'm putting into the policy is dependent on that rate, right? So if it's not dependent on the rate, because I'm going to put in money every year for the rest of my life, and that rate just means what it's going to grow, then I wouldn't say it's irrelevant, but it's less important as long as someone's explained it to you. So again, Mark, to your comment, I think the biggest issue is not the risk of the dividend going up and down. I think it barely moves, as Simon suggests, but it does go in both directions. I think the bigger risk is how it's explained.
Okay. So maybe we just change topics a bit. Another thing that happened with clients I had was sort of the flavor of the year for the last little while was sort of leveraged, life insurance. You know, it to me as an accountant advising clients, there's aspects that you have to look at. Being, is a client good with leverage? Have they dealt with leverage? Are they in that type of business? You know, is their taxable income going to be enough in the future to deal with the write-offs, the interest write-offs? So can you guys maybe speak to leverage investments a bit, or leveraged insurance? Sorry.
Yeah, Jay, you want to give just a recap of how it works?
Yeah, and in a typical situation with leverage insurance, you know, and I hate when people use terms like, they'll say it's free insurance, and I can't stand that. It couldn't be further from the truth. Actually, I saw Gene Simmons do something on CNN in the U.S. saying it was calling it basically free insurance. But the idea of leverage is, and we'll go back to that concept of cash value. Cash value is what the insurance company will give you to go away. It's also something that banks are very comfortable leveraging against. And the reason banks are comfortable leveraging against the cash value of an insurance policy is because that cash value is guaranteed by AAA companies. And even if those AAA companies went bankrupt, a Sun Life or a Manulife or whoever it is, the money that's in those policies is separate from creditors. It's segregated. It's kept in a separate pool. So from the bank's perspective, there's no better asset to lend against. And so if I had an insurance policy with cash value of $1 million and I had a house of $1 million and I was looking to leverage, whether for an investment or for personal purposes, whatever it might be, and I'm looking at that collateral, the bank will give me 90 to 100% on that cash value. Versus my house, as an example, I might get 60% loan value on a value that I disagree with, because they come back and tell me that my house is only worth $800,000 after assessing it. So from a borrowing point of view, banks and clients love insurance to borrow against. Great asset to borrow against. What the strategy that you're talking about, Mark, is, and again, we referred to it in the last podcast a little bit. For example, a lot of builders and real estate developers and real estate holders use it. Is, I buy my insurance on day one. I'm going to put $100,000 into my policy. And the next day I'm going to assign the policy to the bank, and the bank is going to lend me back my same $100,000. And as long as I then put that $100,000 back into my business, back into a stock portfolio, back into real estate, basically anything with a reasonable expectation of profit, I can now write off the interest. So essentially, let's use an environment where it's 6% interest rate and a 50% tax rate. Then on $100,000 of borrowing, I pay $6,000 of interest. But if I have the ability to write it off, I pay $3,000 net, $3,000, and there's some other minor deductions for what's called net cost of pure insurance. I won't get into that today, but it allows me to, functionally keep my original asset, invest where I would have otherwise invested if I didn't buy insurance, and get the insurance all for the cost of the deducted interest costs. By doing so, again, not only does it allow you to have two assets, it also allows you to, it really does increase the internal rate of return. And the reason it increases the rate of return is because my cost is less. I now am only paying the deducted interest cost. My risk being, of course, obviously interest rates can rise. And I'm going to have more payments over time than I anticipated. You mentioned earlier, the more I'm putting into the policy, the more I'm borrowing, the larger those interest payments are, the larger the deductions are. I have to have enough cash flow to be able to use those deductions. That can be a particular problem where people are capitalizing their interest and constantly just reborrowing their interest amount. So their loan amount is growing, and they might not have the cash flow to use all the deductions. And also, I think the biggest problem to me is someone says, I have a $20 million tax liability, I'm going to buy $20 million of insurance. Well, it sounds like they match, but if you've borrowed for it, you have to minus that piece off. And it's shocking how many people forget that piece has to be minused off and go to the bank, but it's real. Now on the corporate side, there's some advantage there, because when you're borrowing corporately, if the loan is set up correctly, and on death, my company receives the proceeds of the insurance, and the loan doesn't have to be paid back until after that, as opposed to the bank getting the proceeds directly. Big difference, because if the bank gets the proceeds directly, then that amount did not credit my company's capital dividend account. if my company gets that that amount, it credits my company's capital dividend account. So use a number. I owe $2 million. I had a $10 million policy. My company gets $10 million. Hypothetically, my company gets a credit to its capital dividend account for $10 million. The bank gets their $2 million back. So I only have $8 million. That's all I have, but I still have a credit to my capital dividend account for 10 million bucks. Under the assumption that when I borrowed that $2 million, I didn't lose it, I invested it, I did well with it, and I have other money, then that excess of $2 million capital dividend account is valuable to me because I can now get another $2 million out of the company. So there's risks and there's rewards, but the answer is, Mark, it's complicated and you need proper advice.
Yes, so to your point, Mark, this is sort of the flavor of the year or the last couple of years. The insurance companies are doing, gobs and gobs of business under this scenario. Jay just explained some of the real benefits of it, but it's not for everyone. I think people it's being sold. And again, this segment is about the hard questions. So where the hard answers are going to come. So it's coming with the wrong dividend scale projected. It's coming with a very low long-term interest rate. We're seeing people already, in the last couple of years, paying a couple % more than they were when they first started this immediate financing mechanism. They don't realize, to what you guys both said, that there's going to be, yes, the premiums stop in 10 years, but your interest payments go for life. It's a long commitment, and a lot of people haven't considered that. And the agent is selling it as a means of, look how cheap I can get you this insurance for, but they're not considering that they're still going to spend $20,000, $30,000, $40,000 a year every year for the rest of their life. And that might as well be a higher number if they don't have the deductions to go against it so that they can write off that interest. So it is not for everyone.
Well, the important part of that, not for everyone, Simon, and I think, Mark, you even referred to it, is this is just I hate the way it's sold. It's sold as a cheap way to buy insurance. That's a terrible way to look at this. First of all, the client's got to otherwise want insurance, right? And if they didn't otherwise want insurance, we shouldn't be talking about this. Secondly, they have to be comfortable with leverage. If people are not otherwise borrowing to invest, and it's not a strategy they've used or thought of in the past, then this is not something for them, right? So if I'm going to borrow against a whole life today, and I'm going to go park all my money in a GIC that I borrow from it, that's risk. It's satisfying risk objectives, but there's no positive cash flow from that. It doesn't make sense. So I'd have to go, take the money. I'd have to put it in the business. I'd put it in real estate. I have to put it in stocks that I feel are going to outperform my interest costs. Not maybe say every day of the year that they're outperforming, but over time that they're outperforming. If I don't have the risk levels for that, and I wasn't otherwise doing that type of thing, then I shouldn't be doing this. The only difference between doing a borrow to invest strategy with insurance versus not, to me, is the two differences are, on the positive side, the difference is that insurance might be better collateral for the bank. So if I'm doing it anyways, then, why wouldn't I use something that's better collateral? And the second reason was, I was buying insurance anyways, and this is a way to enhance it. But negatively, if you're only buying insurance to accomplish this, you had other assets that you could borrow against. And if you went to do that, you said, well, I didn't otherwise want to borrow, then this probably wasn't for you.
Right. So it is being sold that way. Hey, Mr. Client, Mrs. Client, have a look at this. I can get you $10 million of insurance, and it's only going to cost you $8,000 a year instead of $600,000 a year, or whatever the numbers are. And therein lies the problem. It's not, goes back to what we've been saying philosophically about what we stand for here, which is it's being spoken about and sold from a product perspective, as opposed to within the greater context of estate planning. If the estate planning says I need $10 million of insurance, it says I'm comfortable with leverage, it says I have cash flow, then it may direct you towards leveraging. But far too many people are involved in this concept. They shouldn't be, quite frankly. Jay's back.
Yeah.
I'm back. Sorry.
Another thing that I don't think it's controversial because it makes conceptual sense is that for small business owners, they may be aware that their small business deduction has been clawed back due to recent legislation where you have certain amounts of what they call passive income. So there's been a lot of people looking at purchasing insurance to reduce their passive income so the small business deduction remains. Is there anything, Jay, that people really have to be aware of when they're looking at this?
I wouldn't say there's anything specifically to be aware of, but I would go back to the same comment that I just made relative to leverage. It'd be something you should otherwise want. So with the passive investment income rules, if a business owner is being taxed at a lower rate, getting the small business deduction being taxed at 12-13% on their first $500,000, to the extent, and it's 26% above that. My rates might be wrong by a point or two, but to the extent that they have more than $50,000 of passive income, every dollar over 50,000 grinds down that $500,000 exemption by 5. So really, if you have $150,000 of passive income, you're not going to have a small business deduction, and everything's going to be taxed at the higher rate. So if I'm sitting in my business, this happens a lot, for example, in professional corporations where people are sitting on, doctors and dentists, and they're sitting on a few $1,000,000 of assets. The government doesn't want to give you the lower tax rate if you're not putting that money back into the economy and it's just sitting there growing for your own purposes. So you can invest that in things like long-term capital gains that aren't generating any income to get it down. You could look at an individual pension plan. You could try to take the money out. Like there's various things. Insurance, because it grows tax-free, there would be no income, and because there is no income, it wouldn't affect that test, and you would be able to get your lower tax rate. Now, if somebody's sitting on $500,000 of investments and they're slowly creeping up to $1 million, and then originally when the government came out with these rules, they were using a 5% marker. So they were saying like, well, $1 million generates 5%. There's your $50,000 of income. So if you keep that standard, then they could have up to $1 million in that theory without having to worry about losing their small business deduction mark. But so fine. So would you take $100,000, $200,000 and put it into an insurance policy if an insurance policy is something you otherwise would buy? Sure. But if you have $10 million in the company, you're not going to go take $9.1 million of that over a period of time and go shove it into an insurance policy. So the answer is it's helpful depending on what level you're at, meaning how much passive income you actually have. If I have $1 million of passive income, insurance is unlikely going to have a large impact on it. If I have $60,000 of passive income and I'm only $10,000 over, then maybe it will have a significant impact. But I would tell you that you would have to want the insurance and need the insurance in normal course.
One other question sort of is, there's some advisors that are using insurance for to fund charitable donations or after death or even pre-death, and some of them are a bit complicated in the way they're sort of structured. What's your thoughts on on the use of insurance for charitable purposes?
I think it's great on a goals-based agenda. Is it the number one asset to give to a charity for tax purposes? No. But on a goals-based planning, yeah, it allows you to give a more significant gift than you might otherwise give for less money. And there's a lot of different tax strategies that enhance that. And I think that's great. My favorite strategy, and it's not available to everybody, but if somebody had, in a corporate situation, had capital gains, for example, on stocks in their corporation, then they could give, the best way to do it generally is to gift the stocks to a charity. Not only does the corporation get a deduction for that, but there's no capital gains inclusion. And the full amount of the gift will credit the company's capital dividend account. So that's probably the dollar for dollar best tax way to do it. Where I often enhance that is use the benefits of the deduction and the lack of paying capital gains tax and the CDA credit to take those proceeds and buy insurance to either replace what you've given to the charity so that your charity can have it and your children could have it, and then get it out again through the capital dividend account, i.e. use it twice, or enhance the gift to the charity and give the stocks in your lifetime and give the insurance on your passing. The biggest problem with insurance as a charitable gift, Mark, and again, this is all charitable gifting is all goals based, so it's hard to comment on. But the only problem I often see with insurance is when people name a charity as the beneficiary of their policy. During, like, I buy a policy, it's $10 million, a charity is going to get the benefit of that. I name the beneficiary. The problem with naming them beneficiary, of me owning it in my lifetime, is that tax receipt for that donation is now going to happen in my year of death and for my estate. And the question is do I have enough income to offset the donation? And not to say that that's a bad thing that I didn't, but for a lot of our clients, the planning to make sure that we can use all the tax credits going to be generated by that donation, it would have been better off to do it in a different way rather than lose those tax credits because the donation was larger than my income inclusion.
Thanks.
Simon, do you have any thoughts on that?
No, I mean, the only one, having worked with a number of families that, as part of their estate plan and succession plan, they have set up a family foundation, buying insurance that funds, well, first of all, making, donation or making contributions to the family foundation immediately gives them their tax breaks, but also, maybe using those funds to buy insurance on the patriarch so that it then creates far more capital within the foundation so that the family, which we're trying to create family harmony, now siblings are able to now continue to work together and figure out what causes they want. So using insurance to fund not the charity, but to fund the family's foundation so that their legacy can continue.
Yeah, and where that can be more valuable now, and I just kind of thought off the top of my head, I haven't thought too much about it, but the disbursement quotas for foundations went up this year from 2% to 5%. So the foundations are required to distribute 5% of their assets every year to charities. To the extent that some of that money is inside an insurance policy, it would not count towards the disbursement quota, and that in itself might allow larger gifts over time as opposed to pushing gifts up front.
Interesting. Okay. So, is there anything else we want to talk about? I think there was one other topic, Mark, you and I were talking about in terms of insurance on spouse. Like everyone's sort of doing joint last to die insurance policies for the purpose of, again, Jay, you use this example. If I was to buy insurance on myself, it might be $10. Whereas if I buy it on my wife, it's $8. Whereas if I put the two of us together and it doesn't pay out the death benefit until after we both died, it's $7. So a very common way of driving the cost of the insurance policy down, increasing the room for more cash value, whether it's for future leveraging or immediate leveraging. And it's an interesting topic. The numbers do look better, clearly. But Jay and I just were working on a file, for example, recently where it was a couple that was in their, are they even in their 20s? I'm just trying to remember, 20s or early 30s.
Early 30s.
Early 30s. And we have to consider, this is held in a corporation. We know it's difficult to get policies out of corporations. We know it's difficult to take a joint policy and split it into single policies. So it became a very real, and dare I say, gutsy conversation to look at a couple newlyweds and talk about why maybe joint last to die. And again, the topic today is about the hard questions, but with the divorce rate as it is and a couple that's in their 30s, is there value in doing a joint last to die? This is really works best knowing that these guys are going to literally be married until death do us part. So, and even worse than that, second death do us part. So So then the question becomes, does joint last to die structure work at a certain point? Does it work for a 30-year-old? Do we consider it for a 40-year-old? Do we not consider it until they're in their 50s and 60s, where they can have a real look at this and understand that this policy is not going to be unwound, which is costly and very, very inefficient. So again, something to look out for. I'm not giving a blanket answer. There's a time and place when it makes sense, but
Well,
it shouldn't be a
there-
default decision that it's going to be a joint last to die.
Yeah, I think that's the point, is that it needs to be discussed. And although you're definitely right, Simon, that the younger you are, the more difficult it is to kind of see the future, and you should probably not necessarily be looking at joint last to die. And the older you are, maybe the easier it is to see that future and be able to do it. But the one question I often ask people, which I think is, again, harder for younger people to answer, is, and easier when you don't have a corporation, but if you were to get divorced, would you still agree that this money was otherwise for the kids, right? And if you have a lot of money and the divorce is amicable, maybe you can. If you don't have a lot of money and that asset needs to be taken in one manner or another, then obviously it can't. And divorce being amicable is obviously going to affect that conversation. But I've had a lot of clients get divorced over the years, and I've had with joint policies, and it is an asset and it's going to be considered as part of that separation agreement. But I have found, for the most part, that clients hadn't changed their initial goal, that money was always intended for the kids, and they usually are able to keep the policy intact. But it is definitely a concern that people should be talking about. Corporate situations, it's a whole other ball game, because there's what if it has to move, what if it has to come out, like that? It's a whole other problem. But on a personal level, I think it's just a discussion based thing. Mark, have you run into clients that had joint policies in their corps, as an example, and got divorced, or were separated?
Actually, I guess it's by fluke that most of the policies were older couples, and they all stayed together. So, Simon, we sort of
Mark's clients stay together, but Jay, apparently your clients divorce a lot.
Yeah, exactly.
Yeah, I hope it's not my fault.
Yeah. So Simon, we sort of had a few questions from an accountant's perspective, where there's some hard questions that aren't always necessarily brought forth, but from your perspective with dealing with accountants, is there questions that you sometimes think maybe accountants should consider that aren't brought forth in these discussions?
And let me make sure I understand. Are questions, in other words, challenging proposals that end up on their desks, or?
Yeah, just in dealing with accountants, when the client is often looking to the accountant to make sure what you're proposing makes sense from a tax and personal perspective and a needs perspective. But from your perspective in presenting these options, do you feel there's a few things accountants maybe should look at, or something that they don't do that they should?
Yeah,
do?
well, it's a great question, and I don't want to be sort of disparaging to the industry. We all know, and we've talked about it, that insurance is complicated, and there's a lot of moving parts. It doesn't need to be complicated, but it is presented in a way that's very, very complicated. It's also very, very intimidating. The last thing an accountant or a lawyer wants to do is look foolish in front of their client. But at the same time, I think they've done all this great work to minimize tax and to work with their clients to make sure that more in their clients' genes than in CRAs. But they do stop short. And I'm not exactly answering your question, Mark, but I'm going to say that the starting point is I would love to see accountants going over that goal line and actually saying, okay, we are minimizing your taxes this year. We're minimizing your taxes long-term by doing this freeze. We're minimizing by setting up this trust and this foundation. But what they're not doing is then saying, okay, we've now crystallized, it's a fact. We know that there's going to be $10 million owing. How are we going to deal with this? And I think if we're talking about tough questions, there are tough questions that an accountant needs to say to the client, which is my role, my job is to keep as much in your genes. How much are you going to keep versus how much you're going to make? And we need to deal with this question. Now, it then becomes intimidating because accountants and lawyers feel like they need to have the answer. And what I would propose from a methodology perspective is that never forget that you, Mr. or Mrs. Accountant, are sitting on the same side of the table as the client, and you're bringing in the expertise to then say, explain this to us, and have your broad topics like, what are your variables that you've used? Have you gone conservative enough? Do you feel that there's more pressure that this could underperform than overperform? It's all the things that we've talked about, but it can't possibly be the responsibility, like you do accounting, the lawyer does legal, the client does their business. It's not their job, none of their job to be able to figure out all the little idiosyncrasies of the policy. Jay, do you have any other?
Yeah. No, I mean, just to, you kind of hit something I think it's important. Most of the time, not all of the time, but most of the time, the accountant tends to be the number one trusted advisor. And sometimes obviously that's deserved, sometimes less, but it's mostly because they're the one the client would interact with most of all of their professional advisors. And the advisory capacity is important. Obviously, the client's looking to the accountant for the tax advice on this. But there's a lot of gray there as far as, product. And I can tell you personally, I don't like it when any professional who's not licensed to do so gives advice on the product, because that advice is usually their own opinion, which they're entitled to, but I shouldn't be giving investment advice to a client because I'm not a licensed advisor. I have my own opinion, but I shouldn't be giving investment advice. I think the role of the accountant there is obviously on the tax side, but when it comes to the product side, if you're truly an advisor as an accountant, I think your job is to ask the right questions, right? And if you ask the right questions, you're highlighting the issues for your client, and then the client will decide ultimately whether or not this is a good return for them. This makes sense. The guarantees make sense for them, whatever it is. It's not, my view versus your view, whether 6% is a good return or 10% is a good return. It's really, are the right questions being asked? And, I think my biggest conflict I've had over the years, whether it's lawyers, accountants, other professional advisors, is statements as opposed to questions. I would like to see, generally when working with other professionals, I think we all have to ask as many questions as possible to highlight the issues for the client, let the client come up with the answers.
Great. Guys, I think I'm going to leave it there for this episode. We're going to get into, again, one of those scarier pitfalls, which is the underwriting side, meaning that we've done all this great work. We've illustrated it. We've even modified agreements, made estate plans. We've done all kinds of things based on this quote, only to find out that the insurance companies come back and declined you or rated you heavily, and all of a sudden the whole game has changed. And how we can impact and put a little bit more power into the hands of the client to have some more control over the process, some more transparency, increased rate of return, create some competition in the business. So we're going to talk about this thing called private underwriting at a future podcast. We might even get some of my underwriting team at my company to sort of get involved, and we can tell a few war stories and how you might be able to prepare, but we'll talk about private underwriting at our next podcast. So again, thanks, Mark. Thanks, Jay. As always, very informative, great podcast. Thanks, guys.
Thanks, Simon. Thanks.
Thanks, Mark. Thanks, Simon.
Bye, guys.
Bye.